Stability feels like the goal. A steady paycheck, predictable routines, a life where nothing collapses unexpectedly. From the outside, stability looks like success. You're reliable, responsible, disciplined. Bills are covered. Stress is manageable. The future looks predictable. Predictability feels like control. But stability is not control. It is containment. When your life becomes stable, something subtle happens. Urgency fades. You stop asking structural questions. You stop asking, how do I build leverage? How do I build ownership? How do I reduce dependency? Instead, the focus shifts. How do I maintain this? How do I protect this? How do I avoid disruption? Maintenance becomes the strategy, and maintenance feels intelligent because nothing is breaking, nothing is collapsing, everything works. But systems that only maintain eventually plateau. Plateaus feel calm. They also quietly limit expansion. The first cost of stability is urgency. When survival pressure disappears, ambition often softens. You stop redesigning your financial structure. You refine the one you already have. Refinement improves income. Redesign builds wealth. Income supports your lifestyle. Ownership reshapes your trajectory. Those two forces operate on different timelines. A stable job increases income gradually. An asset base compounds. Compounding accelerates. Income does not. When stability dominates your strategy, income becomes the primary engine of progress. But income has limits. Time limits it. Energy limits it. Opportunity limits it. Assets operate differently. Assets detach growth from effort. They expand even when you are not actively working. They accumulate quietly. But building assets requires discomfort, uncertainty, delayed gratification. Stability removes the emotional pressure that pushes people toward those choices. When life works well enough, the incentive to build leverage weakens. Comfort encourages preservation. Preservation discourages risk. Risk avoidance limits ownership. This shift happens slowly, not through one dramatic decision, through 1,000 small ones. Choosing upgrades over investments, choosing routine over redesign, choosing predictability over opportunity. Each decision feels harmless. Each one protects stability. But together they create a ceiling. Ceilings rarely appear suddenly. They form quietly, invisible at first. You still earn, you still progress, but progress becomes linear. Linear progress feels productive, but wealth is rarely linear. Wealth is exponential. Exponential growth requires patience. Patience requires discipline. Discipline often requires discomfort. Stability removes discomfort, and without discomfort, most people stop expanding their structure. They protect the life they built, instead of building the life that compounds. That is the first price of stability, not failure, not collapse, containment. A life that functions well but expands slowly. And slow expansion over decades creates the quiet difference between stability and freedom. The second price of stability is tolerance. Not tolerance for difficulty, tolerance for risk. When your life becomes predictable, your relationship with uncertainty changes. Volatility stops feeling like opportunity. It starts feeling like threat. If your income arrives consistently, anything that threatens that consistency feels dangerous. Even when the opportunity is rational, even when the upside is significant. Security trains the mind to protect. Protection becomes instinct, and instinct shapes allocation. You begin choosing certainty over leverage, predictable income over ownership, stable growth over exponential growth. Each decision makes sense in isolation, but over time the pattern compounds. You reduce exposure to volatility. Reduced volatility reduces risk. Reduced risk reduces upside. Upside is where separation occurs, not in marginal raises, not in incremental promotions, in ownership. Ownership fluctuates. Ownership feels unstable. That instability is the price of acceleration. But stability conditions people to avoid acceleration, because acceleration requires tolerance for uncertainty. The longer someone lives inside predictable systems, the more uncomfortable unpredictability becomes. Risk tolerance shrinks. Opportunity begins to feel reckless. What once looked like possibility starts to look like threat. This is how stability quietly reshapes behavior. It narrows the range of acceptable outcomes. You choose safe expansions, small investments, low volatility allocations. Everything feels responsible. Responsibility is important, but responsibility without leverage creates ceilings. Leverage requires asymmetry. Limited downside, massive upside. Those opportunities rarely feel stable. They appear uncertain, uncomfortable, unpredictable. And stability trains people to reject all three. Meanwhile, those willing to tolerate controlled instability begin accumulating ownership. Ownership compounds. Ownership multiplies. Ownership eventually detaches income from effort. That detachment changes everything. Income becomes optional. Negotiation power increases. Time becomes flexible. Flexibility is what people think stability provides. But stability rarely provides flexibility. It provides reliability. Reliability means you know what will happen. Flexibility means you can choose what happens. Those are very different conditions. Flexibility requires margin. Margin requires assets. Assets require earlier instability. Most people invert the sequence. They seek stability first. They delay ownership. They delay leverage. They delay risk. By the time they want flexibility, their structure is too heavy to move easily. Obligations are higher. Baseline is higher. Risk tolerance is lower. So stability becomes permanent, not because it was the goal, because it quietly removed the tolerance required to escape it. That is the second price of stability. Not stagnation, restriction, a narrowing range of choices that compounds quietly over time. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. The third price of stability is time. Not the time you spend working, the time you lose to slow structures. Stable systems move predictably. Predictable systems move slowly. Salary increases come gradually. Promotions arrive occasionally. Progress happens in measured increments. That rhythm feels normal. But wealth does not grow at a normal pace. It grows exponentially. Exponential systems reward early positioning. The earlier capital enters the system, the longer compounding operates. The longer compounding operates, the faster growth accelerates. Time amplifies structure. If your structure is linear, time multiplies linear results. If your structure is exponential, time multiplies acceleration. Stability tends to anchor people to linear structures. Work more, earn slightly more, upgrade slightly more, repeat. Each cycle feels productive, But productivity is not the same as leverage. Leverage changes the slope of progress. Without leverage, progress depends entirely on effort. Effort has limits. Hours are finite. Energy is finite. Opportunity is finite. Assets operate differently. Assets multiply through time. Multiplication creates separation. Separation rarely appears early. It appears later, when compounding reaches escape velocity. By then, the difference is dramatic. Two people start with similar incomes. One prioritizes stability. The other prioritizes ownership. At first, their lives look identical. Similar salaries, similar lifestyles, similar progress. But ownership compounds silently. Each year returns reinvest. Each reinvestment accelerates the next. Growth becomes non-linear. Meanwhile, the stable path continues predictably. Income increases, expenses increase, savings increase slowly. Everything appears responsible. But responsible structures are not always accelerating ones, and acceleration is what changes financial reality. The longer someone stays inside purely stable systems, the more compounding time they surrender. Lost compounding time is expensive. Not immediately, over decades. 10 years of delayed ownership can mean 20 years of delayed autonomy, because compounding needs runway. Runway disappears when time is consumed by maintenance. This is why stability feels safe early. Nothing dramatic happens, nothing collapses, nothing appears wrong. But the absence of crisis does not mean the presence of acceleration. Acceleration requires allocation. Allocation requires discipline. Discipline requires prioritizing assets before lifestyle expansion. Most stable systems invert that order. Income increases, lifestyle expands, investing receives the remainder. The remainder rarely compounds aggressively. Over decades, the difference grows, not through dramatic decisions, through structure. Structure determines trajectory. Trajectory determines wealth. And stability, when left unexamined, often anchors people to structures that move too slowly for compounding to fully take over. Stability is not the enemy. Misunderstanding it is. Stability should be a foundation, not a destination. A stable income can support discipline. A stable life can create margin. A stable routine can allow long-term thinking. Those are advantages. The mistake is turning stability into the entire strategy. When stability becomes the goal, expansion quietly disappears. Maintenance replaces momentum. Protection replaces allocation. Predictability replaces leverage. Over time, that shift becomes structural. Income supports lifestyle. Lifestyle supports obligations. Obligations require continued stability. The loop closes. At that point, stability is no longer optional. It becomes necessary, and anything that threatens it feels unacceptable. But real financial strength comes from optionality, the ability to walk away, the ability to wait, the ability to choose. Optionality requires assets. Assets require earlier discipline. Discipline requires resisting automatic lifestyle expansion. That resistance feels strange in stable environments. When income rises, the natural instinct is improvement. A better house, a better car, a better standard of living. But standards rise faster than people expect, and rising standards quietly raise financial gravity. Higher gravity makes movement harder. This is why many people with strong incomes still feel constrained. Their income supports stability, but their structure does not support flexibility. Flexibility comes from leverage. Leverage comes from ownership. Ownership comes from consistent allocation. Allocation before celebration. Assets before upgrades. Structure before comfort. When stability is used correctly, it becomes powerful. It creates the conditions needed for disciplined investing. Predictable income funds consistent ownership. Ownership compounds quietly. Over time, the structure changes. Income becomes less essential. Assets begin carrying more weight. Pressure declines. Choices expand. Stability then serves its real purpose, not as the ceiling of your life, but as the platform that allowed compounding to begin. The price of stability is only paid when stability replaces strategy. Used correctly, it becomes leverage. Used incorrectly, it becomes containment. If this reframed how you see stability, subscribe. Like this if it clarified something.